just think it's a reality that the US is in better shape on a relative basis than the rest of the world. I think the US has advantages that the rest of the world does not. And as a result, I think global capital will find its way into the dollar and into the US markets. And so on a relative basis, that will allow us to be the last domino standing, so to speak.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. 2022 has seen the worst inflation in 4 decades, stubbornly persistent supply chain shortages, a contracting economy that may already be in recession, and one of the worst first halves of the year for the financial markets. And yet, the US dollar is the strongest it has been in 20 years. That may seem counterintuitive unless you look through the lens of the Dollar Milkshake Theory. When you do, you understand an awful lot of what's been driving the action this year. To understand where the dollar is likely headed next and what further implications that will have on the investing landscape, we welcome Brent Johnson, CEO and Portfolio Manager at Santiago Capital and developer of the Dollar Milkshake Theory, back to the program. Brent, thanks so much for joining us today.
Thanks for having me. I'm happy to be here.
All right, Brent. Well, look, always great to have you on the program here. I want to really dive into the Dollar Milkshake Theory and how it's explained a lot of what's gone on this year and may continue to explain what's going to happen going forward. Real quick, let's just kick off with a question I like to ask you every time you come on, which is, what's your current assessment of the global economy and financial markets?
Well, I think they're a bit precarious, to be honest. That doesn't mean that it's going to be Armageddon tomorrow, but I think that there are a number of challenges facing the entire world, not just the United States. And, quite simply, I don't think that the monetary authorities and the governments have the skills to successfully navigate it. You could argue they're the ones that have got us into this mess. And I guess the idea that they're going to get us out of it in a graceful manner is a little suspect in my mind.
All right, sort of like the Einsteinian quote that you can't solve the problems you created with the same thinking that led to their creation. Maybe the leaders that got us into this jam can't be the leaders to get us out of it.
Yeah, I think that's probably a fair way to say it.
Okay. All right. So precarious, lots of global risks out there, and maybe the wrong people driving the ship at this point in time. All right. So let's just start at the heart of it. I mentioned your Dollar Milkshake Theory in the introduction here. For the perhaps zillionth time in your career, would you mind just giving a quick description, synopsis of it for the people watching that maybe haven't heard about it in the past?
Yeah, I think the best way to explain it is I tried to come up with a very simple analogy to explain to my clients who are not necessarily versed in, sophisticated financial terms, for lack of a better way of saying it, a way to explain to them what I thought was going to happen as we enter a global currency and sovereign debt crisis. So the Dollar Milkshake Theory is the framework via which I see a sovereign debt crisis playing out. Now, I thought we would already be in a sovereign debt crisis. The powers that be have been able to successfully kick that can down the road longer than I thought they would be able to. But I do feel like we are coming up on it again. And I still think the theory has validity. And what the theory says is that over the let's just use the last 15 years since the global financial crisis. The reality is we could probably go back 20, 30, 40, 50 years. But if we just focus on the last 15 years, I think most people involved in the markets today are very familiar with the extraordinary monetary policies and measures and influence of central banks and governments have had on the markets over the last 15 years. They've provided an incredible amount of liquidity, stimulus, again, however you want to define that, QE1, QE2, Operation Twist, et cetera, not just in the United States, but the Bank of Japan did it, ECB did it, Bank of England did it, China did it, Australia did it, everybody did it, right? So the way I describe it is the world mixed this milkshake of liquidity. And they did that to paper over all the bad debts that were out there. But for a number of reasons, a lot of them having to do with the fact that the United States and the US dollar has the global reserve currency status, that the US dollar and the US markets are the ones that have the straw. And so it doesn't really matter who mixes the milkshake. What matters is who has the straw and is able to drink it. And so I think that the US and the US dollar are going to drink this milkshake that the rest of the world has produced and is continuing to produce. I got this name from a movie called There Will Be Blood, where there was this oil baron who was negotiating a piece of land next to him, and the other guy really wanted this guy to buy the land from him. And finally, he just said, I don't have to buy your land. All I have to do is stick a straw down into the ground and I can drink your oil. He said, I'll drink your milkshake. And I think that's a pretty good analogy for what I think is going to happen as we enter a sovereign debt crisis. I think for a number of reasons, perhaps they're deserved, perhaps they're not deserved, but I just think it's a reality that the US is in better shape on a relative basis than the rest of the world. I think the US has advantages that the rest of the world does not. And as a result, I think global capital will find its way into the dollar and into the US markets. And so on a relative basis, that will allow us to be the last domino standing, so to speak.
Okay, and I know that you have said you don't portray yourself as a lover of the US dollar, meaning you think it's the best currency imaginable. You just think it's the best option of a lot of bad options right now. Is that true?
Yeah, I mean, this is in no way a defense of the policies or the fiscal management of the United States and the Fed and the politicians that have put us in this situation. I would, if we were just analyzing the United States in a vacuum, I'd say we're in a lot of trouble, and I do think we're in a lot of trouble. The issue that I point out is we're not the only ones in trouble, right? The rest of the world is in the same situation, and I would argue in a worse situation. And these other countries and these other governments, these other economies do not have several of the same advantages that we have. And so it's important to understand that the currencies trade relative to each other, and relative levels of fiat currencies. Even if you hate all of fiat, the level that fiat currencies trade against each other have real world impacts for everybody. So I don't think it's a situation where you can just ignore the fact that all fiat is bad, even if one of them is better than all the others.
Okay, and I know a lot of people in the precious metal or crypto space sort of have that mantra that, hey, all fiat currencies are going to the graveyard, and all I need to do is be in this better store of value, and I'm going to be fine. And I'm not saying this. I'm not saying don't do that or don't own some of those assets. Yep. But you're saying it's not as simple as that. You live in a world that is still very much impacted by these exchange rates between these different fiat currencies, and big swings in them are going to impact your life no matter kind of how you're positioned. True?
Yeah, absolutely. I mean, I'll use another analogy, and maybe this is a good one, maybe it isn't, but if you go to prison, the currency is cigarettes or sardines or whatever it is. Now, can you imagine you're trying to trade for something in prison, and somebody hands you sardines or cigarettes, and you say, hey, that's not money, gold's money or Bitcoin's money. Well, it doesn't matter if that's what you believe is money, because in prison, cigarettes are money. And it's kind of the same thing, right? Like, you can have your own opinion, and you can believe in the long term that you believe that the best form of money is eventually going to win out. But in the here and now, in the day to day, you kind of really need to understand how the system works. And the idea that you can just go it alone and ignore reality and sit on a mountaintop and not worry what's going on with the rest of the world, I think is a bit naive. So I think it's very important to understand the game and how the game works, even if you don't like the game.
All right, and we'll talk in a little bit about what assets you do like, and I do know that precious metals at least play a role kind of in your worldview. So you're not anti them by any stretch, but you're just saying we have to be cognizant of the rules of the game that we're currently stuck in, right? Yeah. All right, so some clarifying questions about the dollar milkshake theory. So the first is you think this is important in the context of a global sovereign debt crisis. Can you just describe what you think that crisis, how it will manifest when it manifests in full force? For folks that don't know exactly what you mean when you say sovereign debt crisis and why they should care. Why is that such a big boogeyman here?
Yeah, so let me unpack it in kind of in a big picture way, and I'll bring it down to some specifics. Essentially, a sovereign debt and a sovereign current crisis, if that were to happen, in my opinion, it would be one of the worst possible market environments, because that is an environment where people around the world are losing faith in their governments and in the money that they transact in their local economies. And when people start to lose faith in their government, it's not just bad things in financial markets that happen, but it's bad things in social markets that happen, right? This is the environment where revolutions happen. This is the environment where new governments come to power, sometimes violently so, right? And so, a sovereign debt crisis is the other reason that it's very important is that, again, if we just trace it back 15 years, we can go much further than that. But if we just go back 15 years, you could say in, the early 2000s, we had the dot-com bubble. And after that, everything kind of bubbled up to the bank balance sheets. And then in 2008 and 9, the banks all got in trouble. And, the governments bailed them out, and all the problems bubbled up to the central bank balance sheets and the government balance sheets. Well, now where do they bubble up from here? Well, there's no place to go, right? This is the end of the line. So now when all of these problems that have been papered over by governments and central banks are now sitting on the central bank balance sheets, when citizens and investors and market participants around the world start to lose faith in those governments or those monetary authorities' ability to manage the process, then they start selling those government bonds, and they get out of that currency that's issued by those governments that they no longer trust. And then those governments can no longer fund themselves. And when they can no longer fund themselves, then they can no longer provide essential services to their citizens, right? And so then the heat goes away, and the food goes away, and the streets are not cleaned. And that's when you get real societal upheavals. And so that's why it's such an important thing. And part of the reason that I've been pounding the table that this is going to take place is the amount of debt. There's like $300 trillion of debt in the world now. That doesn't even include derivatives, just like something like 300 trillion of global debt. And we have a slowing global economy. And so, these debts are just having a really hard time being serviced. And the bigger problem is that a lot of this debt is issued in US dollars. And it's not just the United States that has dollar debt, but countries and entities and individuals outside the United States have an incredible amount of US dollar debt. So when the US dollar goes up versus their local currencies, it's almost like they're going further into debt, or it's almost like their funding cost has gone up. So if I use an example, if there is a shoe manufacturer in, Sri Lanka, and they borrow $1 million to build a shoe factory, they now have to service that debt. Now, if they took it out in local terms, the interest rate would be much higher than if they take out debt in dollars, because dollars are so much demanded around the world, you can get a better rate if you borrow in dollars. And that shoe manufacturer is probably selling those shoes to the United States. And so they're earning revenue in dollars. And so now they get a lower rate, and they've matched their liabilities to their revenues. So they don't have to be currency traders, right? Okay, that's fine as long as the dollar then goes down, because now they can pay off their debt with a depreciating dollar. The problem is if the dollar goes higher. So if you borrowed dollars, and let's say your interest rate was on, just to keep it simple, 5%, and then the global growth slows and you have trouble meeting that 5% interest rate, but then on top of that, the dollar rises by 5% versus your local currency, now your interest rate is effectively 10%, or your principal balance has gone up by 5%. So you're getting yourself in a bigger hole. And it's in this type of environment where, again, when a family goes bankrupt, it's sad, but it doesn't affect the whole country. When a company goes bankrupt, it affects, perhaps a whole town or a whole neighborhood. But when a country goes bankrupt, it affects the whole country. And then that typically has knock-on effects to the country next door and the, countries in the region. And eventually it bubbles up to the whole globe. And so I think that's where we're at now. And you can see this happening all over the world. It's happened in El Salvador, it's happened in Peru, it's happened in Ecuador, it's happened in Sri Lanka, it's happening in Chile, it's happening in Egypt, it's happening in Argentina, Turkey. It's even happening to a certain extent in Europe and Japan. So you can kind of see this everywhere now. It hasn't manifested into a full-scale crisis yet, but if you're looking, you can see the smoke is starting to rise. And I think it's it has a lot to do with the amount of dollar debt out there.
Well, and that's kind of a scary amount of the globe that you just covered in that list, right? It's one or two little, teeny countries. It's lots of different countries all over the world and some pretty big regions, maybe. All right, so you talked about the the importance of dollars outside of the U.S. That's called the Eurodollar System. And correct anything that I'm saying here, Brent. But it's called the Eurodollar System, and I recall, in previous conversations with you that you've said it's actually the Eurodollar, the number of Eurodollars that are out there. Their dollars or their US dollar denominated debt, and collectively they're substantially more than the actual dollars inside the US. So a couple of things. I conclude that must mean that the relative strength of the dollar versus other currencies is highly influenced by what's going on in the Eurodollar market. That correct?
Absolutely. Yes, absolutely. So if you think back to the way the monetary system is designed, you have base money, which is the physical coins and the currency that we walk around with in our pockets. And then it's the reserves that's set at the central bank. All other money in existence is loaned into existence. Okay, so the base money is the only money that actually exists kind of physically. Everything else is a loan that's created, and that new money creation has an interest rate attached to it. And because of that, you have to have two things. The system has to grow, or there has to be enough velocity or interaction or circulation of the money currently in existence. And if money is flowing and money is circulating, then $1 can pay off or can service the debt on a number of different people's debt. But if it's just sitting there, there's not that circulation of money, and debts start to happen. So then, but if it keeps growing, then there's more money, and that kind of provides circulation in and of itself. And that is also why when we get into a credit crisis where supply starts to contract, loans aren't being made, it has a kind of a cascading effect where you get a crunch. And it's the design of the system that forces the central bank or whoever the monetary authority is to then come in and put more collateral into the system to recollateralize it. So the system, it's just important to understand that to survive, the system has to grow. Now, back about 30 years ago, maybe more than that, in the late 80s, early 90s, was the last time somebody that I can find, and if somebody has more info on this, I'm happy to take a look at it. But the last was Morgan Guarantee tried to measure the Eurodollar market. And at the time, at their best calculations, the Eurodollar market was 2 or 3 times bigger than the US domestic dollar market. Now think about how much the US dollar market has grown in the last 30 or 40 years, the amount of debt that's grown in the last 30 or 40 years. And then if you understand that the system has to grow in order to survive, then you also know that the Eurodollar market has to have grown over the last 30 or 40 years. So if it was 2 or 3 times bigger than the US market 40 years ago, imagine how big it is now, right? And I don't know how to measure it exactly. I wish I did, but it's huge, it's enormous. And the problem is when that Eurodollar market seizes up, or when that Eurodollar market stops growing and there's a credit crunch in the Eurodollar market, there is no monetary authority that has jurisdiction outside the United States that can go and put new dollars into the system. Only the US government and the US Fed can create new dollars. And so, it becomes a real problem. And it will eventually cascade all the way back to the United States itself. So the people that say eventually the US will have to put the whole Eurodollar market on its back, I don't disagree with that. But what I do disagree with is that it's going to hit the United States first. It's not going to hit the United States first because we actually can print the money. We can create the collateral. We can create the reserves necessary. The rest of the world cannot. And so it's it starts on the periphery and it works its way towards the core. But I think and I think that's kind of what led to 2008. It's what led to the repo crisis in 2019. It's what greatly contributed to the rise of the dollar in 2020. And now you see it rising again in 2022. And the one point I want to make sure I make, maybe you were going to bring this up at some point, but I have a lot of people that tell me, well, all the Fed has to do is come in and print again and the dollar will fall. And the short answer is yes, that's probably correct. If they were to come out tomorrow and say they were going to now do another round of QE and send checks to the citizens, et cetera, that would probably, in the short term, probably make the dollar fall, just like it did in 2020. But the problem is that now it's very, very hard to do that because of all the inflationary pressures. If they go back to QE now with inflation being very high, it's probably going to push inflation even higher, or has the potential to push inflation higher. Whether it would or not, I don't know, but it's just not as easy for them to do it now as they did 2 years ago. The other thing is, if you think about everything the Fed did over the last 2 years, helicopter money, sent checks to everybody, bought high yield bonds, did PPP bailouts of failing businesses, all of these things. And yet here we are, and the dollar is up 20% over the last year, or whatever the number, maybe 15% over the last year. And so I think you have, and I can take it further back. If you go back to 2008, since 2008, we've had QE1, QE2, QE3, Operation Twist. We've had numerous bailouts, numerous stimulus packages. We had the COVID response. We dropped the money from helicopters. We had crisis at the Fed, where insider trading scandal at the Fed. We had all kinds of problems. And yet the dollar is 25% higher than it was in 2007, 2008, before all this began. So to the people that tell me that all the Fed has to do is print money and the dollar is going to take care of the problem, well, it hasn't taken care of it yet. And they've tried pretty hard. And so it's not as easy to solve this problem as everybody thinks it is. And I think that's why we have the dollar where it is today, despite all the protestations to the contrary.
All right. So the visual that's conjuring in my mind here is, and I'm being a bit hyperbolic, but it's a pebble and a boulder, where the US currency market is the pebble and the Eurodollar market is the boulder. And you could increase the mass of the pebble by 50% or more, and it's going to be dwarfed if the size of the boulder decreases by like 5%.
That's absolutely. So while money supply in the US may be growing, global money supply or global dollar supply could still be contracting.
Great.
And this is part of the problem when you start comparing M2 charts and you show the great expansion of M2 in the United States versus the expansion of M2 in other countries. And even if you show it relative to the size of the base, or you show it relative to the size of the economy, because when the US prints money, they do it for the whole world. When the UK does it, they do it for England. When Europe does it, they do it for Europe. When China does it, they do it for China. But when the US does it, they do it for the whole world. So when you look at these charts, when you're calculating it, the dollar creation, you're using the wrong denominator. And so while it looks dramatic, it isn't nearly as dramatic as it is for the other currencies. And that is why you've seen the other currencies fall dramatically versus the dollar. Because while the US, you could argue the US dramatically increased supply, on a relative basis, the rest of the world created a lot more.
All right. So 2 more clarifying questions, and then we'll get to some other specific things happening in the world. So this is why looking at the health of the rest of the world is so important, as you said, because if the rest of the world starts faltering, then you start having those issues that you were talking about, where all these countries that are trading in dollars, or even worse, have lent in dollars, they start being unable to either produce as much economic output as they did before, or these Eurodollar loans start defaulting, which means that that boulder is beginning to shrink a little bit, right? And that then drives the price of the US dollar higher relative to other currencies, because there's now fewer Eurodollars out there versus other currencies. And that sort of exacerbates the situation, right? So we have this danger of a cascading effect, where if the rest of the world starts getting into enough serious trouble, you get this cascade going through the Eurodollar market, the exchange rates go bananas, then money just starts seeking safety. As you said, people start trusting one another, rates start going higher, raising the cost of capital for everybody, which makes the situation even worse. So that's the big boogeyman here. And I think I finally, hopefully, have helped folks understand that.
Yes.
So you said in that case, you think that the US ends up drinking the rest of the world's milkshake. And I just want to clarify a bit what you meant by that. Is that just means that all the capital seeks the US market as a safe haven, and therefore, our financial assets weather the storm better because there's just such a massive flood of international capital in there? Is it something else? What do you mean by drinking the rest of the world's milkshake?
No, I mean, I think you described it very well. I think as this really heats up, liquidity is going to fall. And I think you're going to see other countries have to provide more liquidity. Japan is a perfect example. Everything that the dollar bears, for lack of better description, everything that the dollar bears say may eventually happen to the US dollar and why you need to get out of it is already happening in Japan, right? And they are already having to flood their market with new collateral and new yen in order to offset the rise in interest rates, to keep interest rates down. And so, I think this is going to, this is how you end up getting hyperinflation. Now, I actually hate the term hyperinflation because I think it's so overused that, especially with relation to the dollar, that it's kind of lost its effect. But the way hyperinflation happens is when you start printing your local currency and there's no external or international demand for it. All of that money just stays in the US or in that specific country. This is where you can see things happening again in some of these smaller frontier countries where they have to print money to go buy dollars to service their dollar debt. But as they do that, they just end up increasing their local supply. But nobody outside that country wants that currency. And so it stays in the currency and it drives up prices, and then the currency loses value. And so, I think this is going to, you can already see it happening in many places around the world. I think it's going to continue to happen. And so I think as that happens, again, there's going to be a lack of liquidity, but for the people who do have liquidity, I think they are going to seek a relative safety. And I think that relative safety is going to be found in the US and the US dollar. And so as that capital leaves those countries or those regions and finds its way into the dollar and US dollar assets, it deprives those regions and those countries of liquidity. And there's nothing worse for an economy or asset prices than a lack of liquidity. And so it's a squeeze, right? It's like a sponge, and it's full of liquidity. But as you squeeze it, all that liquidity leaves that area and it goes somewhere else. And I think as that the world gets squeezed, I think all that liquidity goes into the dollar and into the US.
All right, maybe to murder my analogy, the boulder starts shrinking and the pebble starts growing.
That's right.
That's right. Okay.
Yep. That's a good way to say it.
All right. So we sort of talked about the big world stage here. We've talked about how you think eventually all this stuff floods into the US. It doesn't necessarily mean, US is having the best era ever. It just means it's not faring as bad as the other countries that are out there.
Yeah.
And right now, people have been scratching their heads, which I think you've just done a great job of demystifying for them, as to, wait a minute, we've got the highest inflation that we've had here in the States in over 40 years, and yet the dollar is like the strongest it's been in 20 years. How can those two things square? Well, I think you just squared them for us, which is basically the rest of the world operates under a different set of rules than the domestic US market when it comes to currency, and you just laid out what those rules are. We can still have a strong dollar outside the US while we're still watching the purchasing power of our own money
Right.
decrease rapidly here in the States.
That's right.
So let's talk about the Fed for a moment here, because the Fed is still they have, I think, if I interpret what you said correctly, they've got much more impact inside the U.S. It's not that they don't have impact outside of the U.S. What they do does influence the Eurodollar market,
Yeah,
just
absolutely.
not as completely as it does inside the U.S. Correct?
Correct.
All right. So right now the Fed is tightening. In theory, and I guess maybe you have to compare it to what the other central banks, how much they're tightening, but in theory, that actually does add to the strength of the US dollar versus other currencies, correct?
Correct. Yes. If you think about, if people aren't familiar with, relative currency levels and relative exchange rates and relative interest rate levels, just think of it as if you were shopping for a bank. Let's say you move to a new city and there's 5 banks and you have to pick a new bank, and you go around and one bank has a history of going bankrupt and they don't pay you any interest. There's another bank that pays you a little bit of interest, but the liquidity is not very good. And then you go to a third bank, which, they've never gone bankrupt. They have great liquidity. Everybody in the town uses them and they pay you a higher interest rate. You're probably going to go with that third bank. It just makes the most sense. And that's kind of how you can visualize the US. The US is raising rates more aggressively than the rest of the world. Now, there are some other places that are raising rates as well. We're not the only ones. But relative to Japan, relative to the major economies, China, Japan, and Europe, we are raising rates much more aggressively. And that is why you've seen the dollar appreciate, because just like you moving to that new city, picking that new bank and putting your money into that bank, as we have raised interest rates more aggressively than Europe, Japan, and China, investors and asset allocators have said, I'm going to put my money in the Bank of the United States, which is the dollar. And so, it is getting the capital flows, and that's why the dollar has outperformed those other major currencies, or it's one of the reasons why that has happened.
Okay. All right. Well, so right now the Fed is raising the interest rate that it's willing to pay people at the bank, to use your bank analogy here, right? And there's a lot of debate right now amongst many of the experts that I have on this program of how long it's going to be able to do that, right?
Yep.
I would say sort of the consensus is that the Fed's going to try to keep hiking rates. Sorry, it's going to try to keep hiking rates until quote unquote something breaks, and the debate over how quickly it's going to be forced by a breakage to pivot seems to be kind of one of the bigger debates that's going on right now. I know, for example, you and Luke Roman have a lot of back and forth on Twitter, and we had Luke on the program not too long ago, and he was sort of saying, I'll be surprised if it makes it through August. We had that discussion probably 3-4 weeks ago. Of course, we're now here at the beginning of August. How long do you think the Fed is going to hike? Do you think it'll surprise people and stay more committed, or do you agree that its events are going to have to force it to reverse course sooner versus later?
Well, I think short answer is I don't know. And anybody that comes on here and tells you that they know, you should probably just stop watching and run the other way, because those are scary people. Nobody knows. We're all speculating here, right? But I do agree that the Fed is going to continue to hike until they cannot hike anymore. And I tend to think that they're going to be able to do it longer than most people think they're going to be able to. Now, is it possible that they have to reverse pivot in the next month? Yeah, it's absolutely possible. But if since the Fed meeting, here's the interesting thing is when Powell came out last week, there's in my mind, there's no question his tone was less aggressive. He definitely came across as not being as aggressively hawkish as he had, in prior meetings this year. But if you listen to what he said, I don't think his words were that much less aggressive. I think he still said, data dependent, we are still planning to raise rates. And he did make the comment that he thought that we were closer to neutral. In other words, getting the Fed funds rate near the inflation rate, we were closer to neutral than we were at the beginning of the year. And so, and the Fed took that, or the market took that as an indication that, he was going to slow down with his hikes.
Right.
And
I'm sorry to chuckle,
yeah,
but just to parse that for a second, that's a true
yeah,
statement. But it's like saying I've taken a step towards up the
right.
mountain. Doesn't mean I'm close to the top yet, right?
Right. Well, okay. So you're kind of helping make my next point, and that is that the market took that as extremely dovish, though, because now he's going to slow down hikes. Well, if we haven't taken very many steps towards the mountain, why do you think he's going to suddenly slow down? Did you see what I'm saying? So if you think inflation is going to stay high, then you have to expect him to continue to hike. But with the market took it as extremely dovish, and since then, long rates have fallen. So the long market, bond market is saying no, he's they don't believe him. But equities took off and moved higher. Oil took off and moved higher. Bitcoin is much higher than it was a month ago. So you've got these risk assets going higher, and if risk assets are higher, it has a higher probability that inflation prints continue to come in higher. And so the market rally is kind of defeating the reason that he would slow down due to data dependency. My point is this: is they are not going to slow down when equities are rallying, the VIX is falling, and long rates are going down. They're going to pivot when equities are falling, VIX is through the roof, and the dollar funding market sees up, right? And so it kind of becomes this game of chicken, to be honest.
Well, so I just interviewed Thomas Thornton yesterday, who's a multi-decade hedge fund portfolio manager and analyst, and he basically echoed that pretty much that same sentiment. The other piece of the puzzle he added to it is he just said, look, the Fed's not going to pivot while the market's moving up. It's certainly while it's above 4,000, and while unemployment is still as low as it is. Right. So I think to your list there, I would add unemployment as well.
Sure. Sure.
So I think that is a good counter argument that's emerging right now in response to people who are saying, "Oh, I can smell the Fed pivot; it's almost here," right? Where it's sort of like conditions are too rosy right now. And the Fed knows. I don't want to put words in your mouth. It knows that it needs more air cover to have more room to act when the next really big true crisis gets here. So it wants to bring rates higher. It wants to take some of the excess out of the system, and we'll do it as long as the thing isn't going into cardiac arrest. And it just seems like the patient's nowhere near that right now.
Right. And I think, and this is where the other part of kind of the whole dollar milkshake theory, I think, comes into play a little bit, is that as the rest of the world sees the US as a better store of value or a better place to allocate assets on a relative basis, and they send their money here, that will push up US asset prices, which in my mind makes it harder for Powell to pivot, right? And so if you think about what's going on in Japan right now, well, they're just destroying the currency, right? So do you want to be invested in Japan, or do you want to, go invest in the US where you get 2% more just to sit in cash? So capital flows to the US. What's going on in Europe right now? Well, not only is there a war on Europe's doorstep, there's an energy crisis on Europe's doorstep, and the ECB just raised rates for the first time in 10 years. They raised rates 50 basis points to get to zero. And at the same time, they announced an additional bond buying program to keep rates low. So where do you want to put your money? And if you put your money in the US, again, it pushes asset prices up, and it makes it harder for Powell to pivot, which keeps interest rates higher on a relative basis, and it kind of becomes a self-perpetuating system. And this is why I say that this has the potential to become a real crisis, because once it gets going, it's really hard to turn. It's like a battleship. Right. Once it gets going, it's really hard to turn, and it kind of becomes self-perpetuating.
Well, all right. So could you in some ways say that the dollar milkshake is like the Fed's best friend right now, which is it's propping up the system that's going to let the Fed, basically do what it needs to do without cratering the capital markets?
Yeah. And that's, again, this is for the people who say the Fed cannot raise rates without bankrupting the country. we can't afford to cover the interest expense. I don't necessarily disagree with that, and I completely understand the point they're making. But what you have to understand is neither can Japan, neither can Europe, neither can any of these other countries, right? And so again, it's if you just want to live in theory and write research papers and work at a think tank, then this is all fantastic. But if you're actually allocating money and living in the real world, you need to understand that it's a relative world and money has to go somewhere. It's big institutions and big asset allocators cannot just sit in cash. They don't have that option. So they're going to put their money somewhere and they're going to put it in the place that is best on a relative basis. And so I think that has dramatic impacts on the rest of the world. And like I said, I think we're already seeing them this year.
All right. All right. So I now want to do my own pivot into talking with you about which assets you think will perform well and poorly in this environment, to help the viewers here who are just trying to be good stewards of their wealth get some ideas for what they can consider. I'm realizing I'm still kind of in the first third of my questions that I had for you. So maybe we do a little lightning round as we get to your recommended allocation. And you had given a very definitive allocation last time we talked that you said you would go to war with, and I want to revisit that with you now that we've seen some war in the markets or some enemy action. But real quick, so you talked about the woes of the Eurozone, real war, they're losing, they got a massive energy crisis that does not seem to have any easy solutions to it. Fast slowing economy, all the hits that the hit parade you were just mentioning. We've got all the issues in Japan, from the demographics to the huge devaluation just this year alone in their currency. China is having its own woes right now. So it does lend a lot of credence to what you're saying here. Let me just ask you to put on the opposition's hat for a moment. What could happen in the world to make the US dollar materially weaken on a international scale?
Well, so it kind of depends on what time frame you're talking about. If the Fed were to come out, if the Bank of Japan were to come out and say, you know what, after all these years, we're finally going to raise interest rates. And if the ECB said, we are going to continue to raise interest rates, and they actually do it. And at the same time, the Fed says, okay, we're going to do the world a break. We're going to go back to an easy monetary policy. We're going to get this dollar lower so it doesn't become a wrecking ball. I have no doubts that the dollar would fall for 6 months, a year, maybe a year and a half. But I don't think that the world would use that as an opportunity to get out from underneath the US dollar debt. I think that what they would do is they would double down and issue even more dollar debt and take out even more dollar loans and continue to transact in dollars. And so a year later, 6 months later, 9 months later, we would be right back where we are today, just like we are right back here 2 years after 2020 when the dollar fell. For the dollar to go down and stay down for the count, so to speak, to where it goes back to 80, 75 and stays down there for a 10 or 20 year period and loses its global reserve status, then I think the US either has to lose a war or agree to a system that the whole world agrees to, where they artificially devalue the dollar, either all at once or over time. If just kind of ad hoc, working on the dollar the way they have for the last 15 years, I think we just end up right back where we are, and the dollar milkshake is delayed, but not defeated.
All right. And you mentioned the potential for the US dollar to lose its status as the world reserve currency. We've definitely seen an acceleration amongst non-Western countries, at least the big ones like Russia and China, India, a few others, to accelerate their plans to de-dollarize in the wake of decisions that have been made by the West in response to the Russian invasion of Ukraine. Do you see the dollar being dethroned eventually at some point?
Well, I think yes, I think I do, because that's kind of the natural way of things. Global reserve currencies typically, have a rise and then they fall and somebody else takes over. But I think it's
measured by centuries. But yes.
Yeah, exactly. In this decade, I do not think that is going to happen. Is it possible in 2030, 2040? sure, it's possible. I think the odds that it happens in the next couple of years is pretty low. But I think you have to understand that for the dollar to lose the global reserve currency status, another country or another currency has to take its place. And I am open to suggestions. If you can come up with whatever currency you think is going to dethrone it, and I'll listen. I think it's very unlikely. Now, I know that many people will say, just look at what the BRICS countries just said at their recent meeting. They want to establish a currency that's going to, eventually replace trading with the dollar. And to which I would reply is, I have wanted to get in shape and be super healthy for 20 years. And my wife will tell you I've failed for 20 years. Wants and abilities are not the same thing. I cannot tell you how many times over the last 20 years I've been told, or I've read an article where the dollar is going to lose reserve currency status. The bilateral trade agreements between countries are picking up. The rest of the world is no longer want to be under the thumb of the United States foreign policy or whims, or however you want to describe it. And I agree with you. The world, many parts of the world would love to get away from the US dollar hegemony. But wants and abilities are just two completely different things. It's really, really hard to do. And I do not think that the US will willingly give away the GRC, the global reserve currency. I think they will defend it to their last breath. And as a result, I think it's highly unlikely that barring some kind of military engagement, that it's lost. And during that military engagement, I think the dollar would go through the roof. Just, maybe it would eventually, the US would eventually lose and it would fall, but during that engagement, I'm pretty sure the dollar would go higher.
All right.
So
yeah.
I think it's this idea that we're going to wake up tomorrow and the dollar is no longer going to be the global reserve currency. I think it's a fairy tale.
Okay. And that's why I'm emphasizing this, which is, you and I have been around for a number of years, and we hear the people who don't like fiat currencies for all the same reasons that we don't.
Yeah.
And just conclude, hey, the dollar is just as bad as the rest. It's going to zero soon. That's why I'm in preferred asset X. Yeah. And I just want to let folks know that that's not a new sentiment. And there's a lot of, there's decades of people who made that decision, went all in on something, and then woke up the next day and the world hadn't changed at all. And you're saying, Brent, you don't see it.
Or they woke up 20 years later and it still hadn't changed, right?
Right.
Yeah.
All right. And then two, just to go back to your bank analogy there, like if you want to displace that bank that everyone was using in your analogy, first you have to create a bank that functions well, right? Which is not simple, right? And then you actually have to woo and demonstrate to people that you're a superior product from one that people have had a good experience with for, in your scenario, over 100 years, right? So you just can't invent 100 years of trust overnight. And a lot of the players in that federation that you just mentioned there are countries that, I think many people over the past 10 years have had opportunity to say, well, that might not be like the world's most trustworthy player on there.
Right.
Now, not trying to say that the US is a saint by any stretch. I'm just saying, when you're asking the world to change the system that it runs on, almost like changing an operating system, you have to give them an awful big reason to switch. It's not an easy thing. Okay. All right. Well, let's get straight to what is, so here we are, middle of 2022. It's been a rough start to the year. We have all the dynamics going on that you listed. Dollar's continuing to be strong. Dollar has now strengthened to a 20-year high. It sounds like you think it's going to stay there. I don't know, maybe it's going to go higher, you think, you tell me. But what is your general outlook for the markets, the financial markets, from your perch right now?
Yeah, so,
our interview with Brent will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button too while you're down there. And remember, we're continuing our new practice of publishing my top takeaways from these weekly interviews. To get mine for this interview with Brent, just go to wealthion.com/AdamNotes. It's totally free. Finally, if the challenging macro outlook Brent has detailed in this interview has you feeling a little nervous about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Brent has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Brent Johnson.